Well, hi everyone. Welcome to the Buffett and Beyond Research Saturday Market Recap. And this is March 15th, 2025. And remember, folks, if you want to walk on this very beach like Jimmy Buffett used to walk, you've got to learn how to invest even better than Warren Buffett invests now. And this week, the market, well, even with the nice rally on Friday, the market is looking at its worst week in a very long time. However, is the Friday rally the beginning of a bottoming process? And we're going to see that in a chart. After all, we just had a 10% correction in the S&P. And our weekly stock analysis video, Ulta Beauty beat on earnings once again, but lost market share for 2024. And its outlook for 2025 is not exactly rosy. But the stock is up 13% on Friday. Of course, it's still down almost 40% for the past 1 year. And in that video, we're going to see exactly why and what is happening to that stock. Now, our ETF video, our top stocks in our NASDAQ 100 portfolio had a great day on Friday. And is our portfolio ready to begin a nice rally once again? Well, folks, we're going to see. And let us look at the S&P 500, and here is that nasty, nasty decline, and ouch. It just kept closing down, down, down. But over the past 3 days, right in here, you can see that the market closed within that bottom band. So another couple of days like that, it will start pulling this bottom band up. And that would be a very, very good sign. And we want to show you that in the next chart, why this is so important. And down here, the indicator is still pointing down, but is it starting to level off right in here? And with a few up days, this might turn up. The blue line turns up over the red line. That would give us a very good buy signal. Now, let us look a little bit closer, and we can see up here, we can see this little double bottom as the market was bottoming out up here, and we had a nice day on Friday, and I'm recording this just about a half hour before the market closes. And let's go down here and see why this formation up here is so important, because we come down here, red lines are down days in the S&P, and the black lines, vertical lines here, are the up days. So on this day right in here, we had the market go down all the way to here and then close right in here, right below the middle. Then on the following day, the market bounced up, closed above the middle there. Following day, it went down and closed at the bottom, which was very, very ominous to be sure. And then Friday, it bottomed out right here, or opened right here, went all the way up and closed a little bit below the high of the day. So some of the traders, and we showed this in the ETF video, some of the traders are saying this is the double bottom that we're looking at. Otherwise, we're looking for the market to go up a couple of days and come back down and maybe test this close right down here. But other technicians are looking at this and they're saying, see this day right here, the market closed right there. Then 2 days later, it went down and it closed above this level right in here. So that's a good sign. Now, a case can be made either way, but you just have to be careful. We all have to be careful that it might come back down and test this bottom level in here. And we have seen, and I wrote about this in the daily letter during the week, is that I've seen it 3 times in the past, 30 years or so, where we got a buy signal at the 10% correction. It played around for about a month and then went down another 10% within days. So you always have to be careful of that, and that's why we're keeping our hedges on with the market. Now down here, we can see this line flattening out down here, and these are 2 moving averages that are calculated. Very complicated, but they are calculated. This is a faster moving average, so as the market starts back up, this one will turn up and cross the slower moving average. When that does, that is usually a buy signal. We can look back every time we got one of these, we got a buy and a rally in the market, and sometimes these signals are very, very good. So we keep an eye on that, and we use this as our intermediate term indicator. So we want to see this turn up before we can call a meaningful rally in this market. So right now it's a trader's market, and Friday was a pretty good day, and it got even better because all the traders that were short had to cover their shorts, and so they had to buy into the market. So we'll see what happens on Monday, which is usually a rotten day in the market anyway. Shouldn't say rotten, but a down day in the market anyway. And then Tuesday really will tell us what is going on. So Monday we kind of look at like, well, might as well take the day off and then really begin on Tuesday. And that's what a lot of the traders do. They just forget about Monday and just make it a long weekend every weekend, which is nice if you know how to make money in trading. So, folks, let's see what happens next week. And when we look at portfolio protection, these puts on the SPYs, which we're going to start trading on the next rally, we're going to trade these in for puts on the QQQs, a little bit more expensive, but boy, when the market goes down, those QQQs really gain in value because the QQQs move faster than the S&P 500. And don't forget, the SPYs are 1/10 of the S&P 500. So, but we keep these on. We've been keeping them on for as many years as I've been in the market, which is over 40, and we've been using these, and this just comes as disaster insurance. Maybe once every 6 years does the market go down more than 10%, or goes down about 20%. And boy, it's nice to know that you have them, because you never know when 20% turns into 30 or 40% or 50%, which we've had twice in the past 20 years or so, actually 3 times in the past 20 years. So every now and then they come into play, and we use certain enhanced income strategies like covered calls to make enough money to pay for these puts, so you get the best of all worlds. And we have the put options on. This is about $150,000 portfolio, and if we go out, you need 3 puts, so we go out 3 months and then just keep rolling over. So, folks, there you have it, portfolio protections in place, and we thought we were going to have to use them, but they gained in value during the market decline, so they continue to gain in value as the market goes down. But once it hits these levels, they were about 7 or 8% out of the money at one point, that they start they start increasing dollar for dollar, or a dollar gain for every dollar lost on your portfolio. At least we try to keep it at that rate. It's not exact, but it's pretty close. So, folks, we had a rough 4 or 5 weeks in the market. We hit that 10% level, actually 10.13% on the S&P to the downside, which is correction territory. And right now we're bouncing off that 10% level. We'll see if that 10% level holds or not, or does it have to be tested once again. We'll see. So right now we had a bad week, even though it ended very nice on Friday. Friday was a great day, but the week as a whole was another down week for the market. So you go out this weekend, you forget about the market, be with your loved ones, stay safe, and folks, we'll see you right back here in a couple of days.